Well, with markets at an all-time high, it's the perfect time to connect with Maneesh Dangi because, why? Because about 3 months ago, when Maneesh and me interacted on the same forum, Maneesh said it's time to buy into equities, and a lot of naysayers said, how can you buy stocks when growth is bad, when GDP's got crushed and there are job losses? Well, Maneesh gave an argument that you must look at markets differently and then understand the implications of market and economy, which are based on valuations, cost of capital, and also interest rates. Maneesh, fantastic to have you back. What you talked about 3 months ago as a trend today is reality. Where do we go from here? Now that the cyclical recovery in the economy has played out and high frequency data points are saying that the cyclicality in the economy is back on track, where do we go from here?
Hi, Nikhil. Good morning. Okay, so I mean, you have reliable indicators sort of confirming to what we discussed even back in May that you would have a fairly sharp recovery in India into festivities. So that's what is playing out. You have GST, PMI, and auto numbers. These are reliable indicators hinting at fairly significant recovery in India. But that's done already, and markets have priced it. Incrementally, I guess you'll have to look at sort of something more fundamental, whether this recovery would fade post festivities or would actually gain momentum. And for that, the metric that I'm using, I think I've shared with you in the past, is we'll have to see whether COVID has scarred balance sheets, particularly financiers' balance sheet. Imagine if, let's say, banks and NBFCs are actually right now, if they are losing a lot of money because of COVID, then their lending standards would be tight. They would not be sort of going after consumer or borrower. And therefore, for incremental growth, since you need more credit, and if they're going to go slow, of course, that would mean sort of growth does not pick up momentum from here. But the good news is, of course, you've heard from all sorts of banks and NBFCs that they are sort of guiding just 1 to 3% of credit losses because of COVID, and which has surprised pretty much the entire street, and they themselves have actually been surprised. So which basically means that financiers are not scarred. Most probably they will begin to dial risk again, as we move into the first quarter of 2021. Also, the other thing that we ought to watch is whether labor markets are demobilized yet. And, there are lots of surveys. There's no great reliable indicator on the labor market, though. But, we're beginning to see, very few people complaining of labor shortages. Sort of labor has come back to industrial belts. There are surveys in this Gurgaon, Manesar belt, Chennai. Even in Bombay, all the construction sites are back open. So all of that sort of, Nikon, suggests to me that the momentum that we picked up over the last 2 months in growth would actually add in next couple of months further. So it's not a pent-up demand playing out. My sense is that we would get into relatively better growth dynamics as we move forward from here. So that's actually a good news for economy. As for markets, of course, large part of the PE re-rating that we discussed in May, June has already played out, and increasingly it would simply be based on how earnings actually begin to play out pretty much across the markets.
Okay. Let's understand the importance of lower oil prices. Lower oil prices is like a lottery for India, and oil prices, given what's happening in the world in terms of EV, I think is here to stay. And the Democrats themselves are very environmental friendly, so they will ensure that energy capex is low. Are markets factoring in this crash in oil and what it means for the economy?
They do, I guess. See, oil has been sort of low since 2016, but it's important, that you bring up this idea of oil at this point in time, because some of the oil disinflation or lowly oil that we see today is not a cyclical factor anymore. You and I have observed this, that, in this big reflation trade where everything in the world has actually gone up, oil actually did not participate in this rally for fundamental reasons, of course. You talked about EV. There are significant advances in battery technologies, and all of that, along with a consensus across developed markets and China, that the way forward for energy is actually renewable. All of that means oil has fundamental headwinds for it, and my bet for last 5-6 months has been that even in 2030s oil would be actually $50 or below. Now that's a big deal for India. As a matter of fact, if I survey last 20 years, sort of as a country we've paid 3.5-4%, somewhere in the middle, that kind of rent to the world when we buy pretty much all the oil that we consume. And now we're likely to pay at $40-50. We're going to most probably pay about 2% of GDP. Now that's a huge saving, Nikun, almost 1.5% of saving as a GDP on 200 lakh crore economy. That's 3 lakh crore. Now, sort of you can begin to imagine that 3 lakh crore of saving, or $40-50 billion worth of saving for a country, what all that as a country that we can do. Can we launch more PLI schemes? Can we do something more productive with that kind of money? You see how states and the government is actually chasing guys like Elon Musk to set up gigafactory in India. All of that is possible because you are saving large amount on oil import. So I think you asked me whether markets are pricing this to a certain extent. The cyclical part of oil, of course, is markets are pricing. But I guess from a growth standpoint, oil could be a very, very big stimulus in next 10 years. Because the same money would get deployed for more productive reasons, Nikun. So my sense is that of many things why I'm extremely bullish on India's growth. After 4-5 years of struggle that we've had. One of the reasons that I am basing that on is actually low oil prices, which are likely to stay. Just get the fundamentals right. Oil is actually a rent on our economy. It actually does not, while of course, helps us to sort of move from one place to another, but, importing all of it actually meant that sustained basis we had, stress on our current account, that would actually go away. And from a financial market standpoint, that would also mean that risk premiums are actually lesser because the pressure on currency would be far lesser in the future.
Okay, fantastic. Let's understand how can one benefit from your bullish view. Fixed deposit rates in a State Bank of India deposit have got crushed from 8.5% to about 5 to 5.5% depending on the duration and the age you represent. Equity markets are at an all-time high. The P re-rating has happened. So how does one go about investing in this kind of an world? Stay overweight equities or remain diversified?
So Nikunj, on equity markets, the play that we had for last 6-7 months, especially after end March, when we discussed, it was largely driven by low rates, would sort of induce higher, what do you call, PEs, and people will begin to look through COVID because it is not a permanent damage on the economy. Now, all of that has actually played out. The company that we ought to have now from here on is earnings, and which is where I think I'm sort of more constructive on, and I'm a macro guy. So frankly, I'm not looking at a particular sector, but broadly, we've had a sort of a drought in earning growth for last couple of years. And, you are beginning to see fundamental shifts now in terms of, some corporates have delevered. I think the pricing power is beginning to come back, and a broader macro actually is conducive for earning growth. And that is what would drive, returns in equity. Since I'm actually constructive on earning growth, I think that our earning growth, which has actually been underwhelming, has been below nominal GDP growth for the last 5-6 years, would actually begin to outpace GDP growth. This crisis has given opportunities to corporates to cut inefficiencies. Our corporates are actually mean machines, in the way they've actually cut costs. Some of it, of course, would unwind, but then, they have used this crisis as an opportunity to let go of inefficiencies and improve the margins. these margins most probably would stay higher than what we've had over the last 5-7 years. And that would mean that the earning recovery in India would be fairly significant. So the big picture view, Nikunj, is that our earning growth would be more than nominal GDP growth over 5 years, and that is the trend for equity. So you ask me as to what do you do with equity or what do you do with asset allocation, given that earnings are sort of the drivers of equity incrementally, and I think that the earnings would sort of grow at a reasonable pace. You still have a case of being overweight equity. You're not going to get the sort of returns, the 50-60% that returns you've actually extracted from our market for the last 7-8 months, but it's going to be still much higher over fixed income. So you're right that fixed income is actually now anchored at 4-5% kind of returns pretty much across fixed deposit, fixed income funds, and so on and so forth. You still have 5-7% of risk premia from equity to be extracted over the next 5 years, year after year. So overweight equity still remains a big picture call, Nikunj.
Morning, Maneesh. You spoke about the major pivot and how Indian corporates really have used this crisis as a huge opportunity. That and earnings potential aside, do you think that kind of momentum purely that we're seeing on the markets now staring at life highs indicates that they are ahead of the curve, that there is a sense of better macros, better economic recovery, earnings upgrades as well coming in for the markets, and that's why this trajectory is here to stay despite a lot of the concerns that we faced off late?
Hi, look at, there are many macro trends played out over the last 7-8 months. One, of course, is that, market initially got the COVID wrong, and it was right also. No one actually knew how this black swan would sort of play out, and how devastating or catastrophic that would be. So in a sense, given that market simply knows now that the virus and its impact on health is not so bad, it is simply repricing normalization. So to a certain extent, the losses because of lockdown are there in earnings, whereas markets are looking through it and seeing future, and therefore it appears that it is running ahead of fundamentals. But I wouldn't say that. Market ought to price both present and future, and futures fundamentals sort of appear fairly strong to me. Now, India actually sort of was underperforming for most of this last 7-8 months. It's only now that it's begun to outperform because markets are taking notice of Indian Inc.'s ability to outdeliver even in stressful times. While the macro and the growth turned out to be super weak, yet the numbers for the corporates did not turn out to be as bad because of the efficiency gains or productivity gains. Markets are also, of course, pricing in potential productivity gains from things like work from home and sort of a lot of other tech stuff, which could potentially be incorporated in actually supply chain and stuff like that. So they are sort of pricing that as well. And finally, from a purely macro standpoint, interest rates are super low and are likely to stay super low for a long time. Think of it like this. About $17 trillion worth of bonds are actually trading in zero or negative. Now, all of that money could potentially get deployed in something which can earn reasonable return, is the ask. And do you think that India's currency would stay stable, given our current account dynamics, given our FDI surge, given broadly the BOP appears to be in super surplus? The answer to that is also yes. So does India offer a good earning yield? Does India offer a good yields as such? Even though a 6% bond yield does not look very attractive to us as Indians, but to outsiders, if the currency stays stable, this 6% INR yield actually converts for them as dollar yield. So my thing is that even from a flow standpoint, we haven't seen much yet. You will see surge of money in country like ours, where you have reasonable yield, reasonable fundamentals in place for both earning growth as well as, yields are reasonably okay. They're not super low. They're not negative or zero. So big picture, I guess, is that, world is excited about places like us and money would continue to pour in. That would mean that, markets could end up doing somewhat more than what they would have actually done in an otherwise counterfactual scenario.
It's been a pleasure chatting with you. Thank you so much, Maneesh. Would have liked to extend the conversation, but we have a jam-packed lineup. Thank you so much for taking time out. Let's take a quick break with news that we're at 12,422, acing ahead for the equity market.